The percentage of the population that is in a position financially to be an angel investor is incredibly low. But let's just say for a second that you are, and what I mean by that is, financially you're well taken care of. The next generation is taken care of. Maybe the generation after that is taken care of, and so you're in the unique position to make some of these high risk bets. The first thing is don't put all of your eggs in one basket. That goes back to your point about scar tissue. Too many angels will go and they'll make one bet on one company, and it goes south. Because the law of percentages say it's going to go south. And then once they get burned by that, they're like, well, I tried it. It didn't work. I don't like it, right? As opposed to saying, hey, how do I figure out how to take the $150,000 total I'm willing to risk, and how do I spread that around to 10 different companies, or at least 7 different companies, or something? And that just goes down to pooling your risk. That just goes back to diversifying that risk. All of the kind of basic tenets of any investment, not just private investing or startup investing. Don't invest in things they understand, and that's a big problem. So I'm going to sound like Warren Buffett here for a second, but his big thing was, I don't invest in things I don't understand. And he understands how the business works. He understands the market it works in, or he doesn't invest in it. It's just that simple. And I think sometimes angels get enamored with the founder. They get enamored with the idea, or they really think that that market segment is hot. And so they go, well, I'm going to go all in on this one, or I'm going to over-index on a single bet as opposed to spreading that risk around.
Right.
And I think that's where we get a lot of it wrong. And once you get burned, you're not as interested in trying, touching the hot stove again.